studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
When preparing a corporate tax return, one of the very first steps is determining what type of income the corporation has earned. In general, corporate income falls into two broad categories: active business income and investment income. Active business income, often called EBI, is income earned from operating a business. This includes activities such as providing services, manufacturing products, construction, retail sales, consulting, accounting, or running a restaurant. In other words, the corporation is actively carrying on business operations to generate its income. Because governments want to encourage entrepreneurship and business growth, active business income usually qualifies for the Small Business Deduction, or SBD. This allows eligible corporations to benefit from significantly lower corporate tax rates. Investment income, on the other hand, is very different. Instead of being earned from operating the business, it is generated by investing money. Common examples include interest earned on savings or GICs, dividends received from shares, rental income from investment properties, and capital gains from selling investments. Since this income comes from passive investments rather than active business activities, it generally does not qualify for the small business deduction. As a result, it is subject to much higher corporate tax rates. A simple way to distinguish between the two is to ask yourself one question: is the corporation earning income by actively operating a business, or is it earning income by investing its money? The answer determines which tax rules apply. This distinction is one of the most fundamental concepts in Canadian corporate taxation. Before calculating any taxes, a tax preparer must first classify the income correctly. Once the income has been identified as either active business income or investment income, the appropriate corporate tax rules can then be applied. When we compare the taxation of active business income and investment income, a natural question arises: why does the government tax investment income more heavily? The answer lies in a fundamental principle of the Canadian tax system known as tax integration. Tax integration is designed to ensure that the total tax paid is approximately the same whether investment income is earned personally or through a corporation, and later distributed to the shareholder. Consider two individuals who each earn $10,000 of investment income. The first person earns it personally and pays personal income tax directly. The second person earns the same amount through a corporation. In that case, the corporation first pays corporate tax on the investment income. Later, when the profits are paid out as dividends, the shareholder also pays personal tax on those dividends. Although the second situation involves two levels of taxation, the tax system is designed so that the combined corporate tax and personal tax closely approximates the personal tax that would have been paid if the income had been earned directly. Now imagine what would happen if corporations were allowed to pay the same low tax rates on investment income as they do on active business income. People could simply transfer all of their personal investments into corporations, pay much lower tax initially, and postpone paying personal tax for many years. This would create a significant tax advantage and undermine the fairness of the tax system. To prevent this type of tax deferral and tax avoidance, the government imposes higher initial tax rates on corporate investment income. Later, through the dividend refund system and refundable tax accounts, part of that tax can be recovered when dividends are paid to shareholders. In simple terms, the higher corporate tax on investment income is not intended as a penalty. Instead, it is an important mechanism that helps maintain fairness and ensures that earning investment income through a corporation does not provide an unfair tax advantage over earning it personally. Understanding this principle of tax integration is the key to understanding why the Canadian corporate tax system is structured the way it is. When we put all the pieces together, we can clearly see how the Canadian corporate investment income system maintains fairness. The process begins when a corporation earns investment income. This could be interest from a GIC, dividends from shares, rental income from an investment property, or capital gains from selling investments. Regardless of the type, the income first enters the corporation. Next, the corporation pays a relatively high amount of corporate tax on that investment income. In many provinces, the combined federal and provincial tax rate is close to 50%. This high initial tax helps prevent individuals from gaining a tax advantage by holding personal investments inside a corporation. However, not all of this tax is permanent. A portion of it is tracked in special refundable tax accounts. At this stage, the refundable tax remains locked inside the corporation and cannot be recovered immediately. The next step occurs when the corporation distributes some of its after-tax profits to its shareholders as dividends. Paying a dividend is the event that unlocks the refundable tax mechanism. Once the dividend is paid, the corporation becomes eligible to receive a dividend refund. This allows part of the previously paid corporate tax to be refunded, reducing the corporation's overall tax burden. At the same time, the shareholder pays personal income tax on the dividend received. When we combine the corporate tax paid by the corporation with the personal tax paid by the shareholder, the total tax is designed to be approximately the same as if the investment income had been earned personally in the first place. Notice that although different types of investment income, such as interest, dividends, rental income, and capital gains have their own tax rules, they all ultimately flow through this same integrated system of high initial tax, refundable tax accounts, dividend refunds, and shareholder taxation. A helpful way to think about this system is like the gears inside a watch. Each gear has a different job, but they all work together to achieve one common goal: maintaining fairness through tax integration. This is the big picture you should remember. Investment income is taxed heavily at first. Part of the tax is refundable. Dividends trigger the refund, and the combined corporate and personal taxes are designed to closely match the tax that would have been paid if the income had been earned directly by an individual. Understanding this overall framework will make the detailed rules and calculations much easier to understand in the chapters ahead.